Hi, welcome back to Let's Talk Forex. I'm Alison, and as always, I'm here with my co-host Chris. And today we're going to be talking about how to create a winning trading strategy. Please stick around to the end because I'm sure you're going to find some very good nuggets in this podcast episode. Hey Chris, how's it going?
Yeah, not bad, Alison. I'm in London, in cold, wet, grey London, but I'm on my way to South Africa tomorrow. It's very exciting, away from the winter. You were just complaining to me about how hot it is down there.
Oh, it's terrible. Very hot.
It's terrible, is it? Oh, I don't know. Come to London. London's pretty terrible. I mean, it's 4 degrees and raining. That's terrible. But yeah, no, I'm looking forward to the heat. I know what you mean, though. After a while, the heat becomes insufferable, but it's hard to imagine it being insufferable when I'm freezing up here. And no, I'm well, Alison. I'm well. How are you?
Yeah, good. Yeah. I mean, it is hot, but it is wonderful as well. It's lovely to go down to the beach and just be in the sea. Be very fortunate down here in Kenton.
That's the thing. When you're right by the beach, it doesn't matter obviously how hot it gets, but it's great to have the sea that close. You can just go throw yourself in the cold water.
Yeah. It really is absolute bliss.
What are we talking about?
No, we're talking about, as I said in the intro, creating a trading plan. And, it's a question we get a lot from traders or from beginners, should I say. Where do they start? So we just want to give you a brief outline on how to get started with that process. And I think it's a good place to start. So,
yeah, exactly. We're going to have a look at a couple things. Understanding market behavior and then developing a robust trading strategy based around market behavior. And it's going to be a simple start, as you said. And then I think if you're a beginner or even if you're an experienced trader looking to refine your approach, I think you'll find something interesting in here. And it's what we're not going to be talking about here is a lot of fancy indicators and complex setups. I think we're going to try and avoid that. And not that they won't help you, but that I think at this point, if you're just starting out, you probably don't need them. And I think we're going to talk just about the foundational stuff. Yeah. So we need to understand the context first before we start looking at these indicators and setup. I think that's the important thing.
We basically sort of categorize market conditions as, in two different ways, should I say. So we look at mean reversion markets, and then we look at trend markets or momentum markets. So those are markets that are pretty clearly going in one direction, either up or down. I guess in this episode, we want to show you how to identify these different market conditions and then what sort of trading plan you can create around these two different market conditions.
Absolutely. And there, you mentioned them right there, the two pillars. I mean, the momentum and mean reversion. So let's start there. I think we'll start with momentum. Do you want to break down what momentum trading is, Alison?
Yeah. So as I said, momentum trading is basically trading when the market is going quite strongly in one direction or another. So it's either a bullish market where you've got higher highs and higher lows, or a bearish market where you've got lower highs and lower lows. We've created a lot of videos on these subjects and we've spoken about it at length. So we can pop a few lessons to that market condition in the notes below. That's basically what you'll look for.
Yeah, and in these trending markets, you're going to see pullbacks and retracements, just basically where the market pauses and takes a breath. But what's great about these is in a trending market, they provide great opportunities for entering the market, whether you're buying or selling, depending on which way the market's moving. And this is really key here. Trends generally last a lot longer than traders expect, than people expect in general. So it's really important to not start anticipating a reversal in the market too early.
Yeah, I think a lot of traders do this. I know I've been guilty of this many times. Trying to predict when the market is going to change is a huge mistake. What you need to do is trade the market that's in front of you. So if there is a trend carrying on, or if you see a trend, then trade in the direction of the trend, basically. You don't want to be gambling and trying to predict where the market is going. You should trade what's there right in front of you.
Yeah, exactly. Gambling is a good word for it. That's basically what you're doing if you're trying to predict when the market's going to reverse. Yeah, like you said, you want to wait for clear reversal signals before you do that. But now let's have a talk about mean reversion trading. And this is when market is overextended. You hear that people often liken it to like a stretched rubber band, and then it snaps back into its original position. Alison, do you want to talk maybe a little bit about how to identify a mean reversion?
So with the mean reversion, you'll see price oscillating between a support and a resistance level. And, you won't see a clear directional bias as you do with a trend or a momentum market. And you'll often see that price reverses at these key levels. So if the price breaks below a support zone, but then reverses, you could probably assume that this is a market that is reverting back to the mean.
And then we also need to have, just mention it here as well, choppy market or a ranging market. And this is where the price moves sideways, where with no clear trend. And it's called choppy because it's like choppy waves in an ocean, just no direction, just lots of noise. But, or ranging because it's just moving back and forth between 2 points. And these are things that, you probably want to avoid trading in these markets, I think.
Yeah, definitely. Trading in choppy markets is really a bad idea. I've seen it myself. As soon as you start trading in the markets that are either not mean reverting or there's no clear directional bias, you really start to lose money. Sometimes you'll get lucky and make money, but that's often when you're trying to predict where the market's going to go. In a choppy market, there's no clear direction, so just avoid it because chances are you're going to come out second best.
Yes, just to recap here, what you want to do is you want to spend some time identifying the market conditions before you get involved. So this means checking on your charts, and don't clutter your charts with indicators. Just use, I would say, probably a 20 period moving exponential moving average is probably good enough to confirm trends. And then for support and resistance, I mean, you just need lines. Support and resistance lines probably pretty good enough for a mean reversion, right?
Yeah, or support and resistance zones I often talk about as well. They're not lines. In a way, it's not a particular point on the chart where you'll see a reversal. You've got to give it a little bit of space because different traders will be looking at different points. And what I often do and what I suggest traders do is that they print out charts on paper and then just train themselves to look at whether something is in a trend, whether you can see a clear mean reversion in the market, and then, draw by hand on your chart. I find just having the paper in front of you, physically drawing on the charts is a really good exercise. And it'll help train your eyes to see these different patterns.
Yeah, no, I agree. It's always better to do things on paper. For some reason, it sticks in your brain a little bit better for some reason. I find that with reading as well. Like, I mean, if you're reading something, it's better to read it on a paperback book rather than reading it on screen.
They've actually done a lot of research on that, and they found that, as you say, you remember it better when it's on paper.
Yeah. So yeah, I think that's really good advice. Print out your charts, and as you say, mark those patterns on the charts that you printed out. But yeah, now that we've covered market behavior, let's talk a little bit about developing a trading plan based on this. So, Alison, do you want to maybe break down some momentum trading strategies?
Yeah. So when I look at momentum trading strategies, the two easiest ones, I guess, to identify, or the two ways that I would suggest starting with a momentum trading strategy is to look for flags. So bull flags or bear flags, depending on whether you are trading, obviously a bullish or bearish market, and then to look for pullbacks. So flags basically have a flagpole, and then which say if it's going up, you'll have the flagpole, then you'll have a period of consolidation, which is the flag itself. And then you'll see that the price breaks out of the flag and continues higher. And then again, you'll get a period of consolidation, and so it goes on. And pullbacks are quite similar in a way. You'll see basically that there's a period of consolidation where the price pulls back slightly, often where traders are taking profits, and then the price continues in the same direction. And a lot of traders I know use the 20 period moving average to identify pullbacks, and they trade basically where it bounces off the 20 period moving average. So yeah, it's quite a simple way to trade momentum if you're just starting out.
Yeah, exactly. I agree with you. You wait for those in a bullish trend, you're going to see those higher highs, you're going to see those higher lows, and then you'll see that pullback. And yeah, those pullbacks are great opportunities. And I think they're really quite easy to identify for beginners if you're just starting out. Yeah, it gives you a lot of confidence to be able to catch them.
Absolutely. Yeah, I totally agree with that. And then, if you look at mean reversion, you'll identify key support and resistance zones, as we mentioned earlier. And then you can look for reversal patterns. So you might look for double tops or double bottoms. A double top often occurs where you have two peaks and then the price reverses down towards a support level. And obviously a double bottom is just the opposite, where you have two sort of W sort of shape and you have then price bouncing up towards resistance. And you can also, pin bars also signal reversals in the market.
And you can also use a tool, something like a stochastic oscillator. It's very useful to confirm reversals. But I think, again, just to reiterate, don't overcomplicate it here. You want to keep your charts clean. You want to be able to focus on the price action. So just keep it simple, keep it clean. Use one or two indicators if you are going to use it, and focus on the price action and what you know to be true in terms of these mean reversal markets.
Now that we've sort of given you a little bit of an idea of how to start formulating a trading plan, one of the most important points to keep in mind is risk management.
Yeah, absolutely. And there's a golden rule with risk management, which is never risk more than 1 or 2% of your trading capital in a single trade, and never risk more than 5% of your trading capital in a single day. So that means if you've got an account with $1,000 in it, that's $10 or $20 per trade. Now, this is really important. You want to start small. Your job as a trader, especially when you're starting out, is not to make money, it's to protect your capital. So your job is to make sure you don't get any less than $1,000 in that $1,000 trading account. And in order to do that, you're going to start small. You're going to protect your capital. And as you gain confidence, as you use these trading plans, as you learn how to identify these patterns in the markets, then you can start thinking a little bit bigger.
And another part of your risk management, of course, is using a stop loss. It's something that we recommend every trader does. And to set your stop loss, you can use something called the ATR, or the average true range. The ATR basically measures the range of movement or how many pips the market has moved over a particular period. And you can basically set your stop loss at 2 to 3 times the ATR. It means that your stop won't be too tight, so you get stopped out by market noise, and it means that it won't be too wide. So that's often how we recommend traders set it.
Yeah, it's good. So if your ATR on, let's say, the Euro USD is 23 pips, you want to set your stop loss at about 46, 47 pips. And your profit target, generally, I think what we say should be about 1.5 or 2 times your stop loss. Wouldn't you say, Alison, about that?
Yeah, that's what I often recommend. Of course, it depends on the market. Sometimes with a trend, fast trending market, you could set your stop a little bit tighter, and then with the mean reversion, maybe a little bit wider. But it depends on you as a trader and what works for you. It's something you might want to experiment with. To summarize, I just want to quickly go through what we've spoken about so far. So you first want to look at the market conditions. You then want to look at the patterns that we've mentioned. So for a trending market, you want to look at pullbacks and flags. And for a mean reversion market, you want to look at double tops, double bottoms, and possibly pin bars that suggest a reversal is about to occur. Then you want to, of course, keep your risk low. And then you could use a tool like the ATR to help you set your stop loss. And then always look at your risk reward ratio when setting your profit target.
Yep, I think that summarizes it very well. And I think we'll leave it there for the day. Thanks for tuning in. As always, I hope you found this episode helpful. Don't forget to subscribe, leave us a review, ask us any questions in the comments if you're on YouTube. Otherwise, you can send us an email at podcast@fxscouts.com and we'll pick that up too.
Thanks, Chris. Lovely chatting to you.
As always, Alison, speak to you soon.
Cheers.